In seeking to achieve inflation that averages percent over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting. We are not tying ourselves to a particular mathematical formula that defines the average. We are not tying ourselves to a particular mathematical formula that defines the average. We are not tying ourselves to a particular mathematical formula that defines the average.
It's killed! Don't blame me, Charlie. I can't see.
All right. Today is Friday, December 31st, the last day of the year. Happy New Year. And folks, I got a good one for you tonight. How about this guy we just watched, right? Jerome Powell, your trusted Federal Reserve leader, who's not even using a mathematical formula. Wow. What possibly could go wrong, huh? And on top of that, remember when he kept saying, we're not thinking about tapering. We're not thinking about raising interest rates. And he even laughed about it, mocking the whole thinking about thinking.
Is it time to start talking about tapering yet?
Not yet.
Well, are you thinking about it now, genius? But anyhow, I don't have a lot of time to waste on this creature anymore. I'm gonna keep it short and sweet because this is the last broadcast for the year. So let's move on right away, folks, and cover the market performance today. And here we go! The Dow Industrial Average closed in the red, down by 59.78 points, or a decline of 0.16%. The Nasdaq closing in the red, down by 96.59 points, or a decline of 0.61%. The S&P 500 also down by 12.55 points, or a decline of 0.26%. Nice flush down candle by the end. It appears that Santa is about to deliver the bags in 2022. What about the sector's performance today? Leading the pack at number 1 and capturing gold, defensives at number 2 for the silver, materials at number 3 for the bronze, industrials. And the laggards of the day led by communication services, technology, and healthcare. Let's contrast this with the performance for the week. Leading the pack at number 1 and capturing gold, REITs at number 2 for the silver, defensives, number 3 for the bronze, utilities. Meanwhile, the only laggard sector for the week is communication services. What about the advance to decline ratios? NYSE 64% advancing today versus 33% declining. The Nasdaq 47% advancing versus 49% declining. The breadth remains awful in the Nasdaq, and it is a warning signal for 2022. Moving on to commodities, futures. What's going on here? Some profit taking here in crude oil contracts. The WTI is down about 2% along with the Brent. Likewise, big down day for gasoline prices, down almost 3%. Likewise, heating oil prices also down by almost 2.5%. On the other hand, natural gas prices rebounding by a little over 5% today. What about softs? Muted activities for lumber and sugar, even cocoa down, be it modestly, but we have a noticeable down day for both cotton and coffee futures. On the other hand, OJ squeezing more gains here, closing by almost 1% gains today. What about metals? Look at the old man, gold, closing the day with some gains, almost 1% in the green here, perhaps a leading indicator that gold will be a top performing commodity in 2022. Likewise, we have silver riding higher with gains of a little over 1%. We also have copper in the green by almost 1.5%. On the other hand, palladium down big, almost 4% today. Meanwhile, platinum on the flat line. What about meats? What's going on here? Lean hogs futures down, losing a little over 1.5% today. Meanwhile, feeder, and live cattle futures pretty much on the flat line. What about grains? We saw some profit taking grains yesterday, and the profit taking continues in canola, wheat, corn, and soybean meal futures today. We also have oats pretty much on the flat line, while we have gains, be it modestly, for soybeans, rough rice, and almost 1% gains for soybean oil futures. Moving on to the big casino, what's going on here? The hottest table by far, even on New Year's Eve. Apple with almost 1 million contracts traded today. About 67% of those were calls. Still not getting to 3 trillion. Every time they get closer to 3 trillion, we see a sell-off, a resistance at that level. This is the third time, by the way. But here it is at number 2, Tesla, the souffle, with almost 1 million contracts traded today. About 60% of those were calls. At number 3, AMD, with a little over 550,000 contracts, about 65% of those were calls. Moving on to the unusual activities that took place in the options market today, starting with the ticker IWM, they're buying puts here. The 208 puts for the expiration date, January 14th, with the expectations that the name will drop down by more than 6.5% by then. They paid about 50 cents apiece to enter this trade, all in all spending about $1 million. What about the trade for the ticker SPY for the S&P 500? The buying puts? The 450 puts for the expiration date, January 28th, with the expectations that the name will drop down by more than 5% by then. They paid about $2 apiece to enter this trade, all in all spending about $2 million. What about the trade for the ticker SNOW, Snowflake? Let it snow. The buying calls here, but on the other hand, somebody is selling covered calls. Pay attention now. But in this case, they're buying the 370 calls for the expiration date, March 18th, with the expectations that the name will pop higher by more than 9% by then. They paid big bucks for this one, $21 a piece. All in all, spending about $12.5 million. On the bottom of the table, what about the ticker GRPN for Groupon? Beaten up severely, and somebody's betting for more pain to come by buying the $20 puts for the expiration date, March 18th. With the expectations that the name will drop down by more than 13.5% by then. They paid about $1.60 apiece to enter this trade, all in all spending about $800,000. Lastly, what about the trades for the ticker XLNX Xilinx? And this is a put spread, by the way. They're buying the 185 puts and they're selling the 160 puts for the expiration date, February 18th, with the expectations that Xilinx could drop down by more than 12.5% by then, but not more than 25%. They paid about $11 a piece for buying the 185 puts, and they received about $5 a piece from selling the 160 puts. All in all, they spent about $2.5 million for this trade. And of course, the entry cost was reduced to about $6 a piece. Moving on to the heat map analysis, what's going on here? This is a daily heat map, by the way. Again, you cannot place any weighting for the action that we got today due to low volume. But the message is clear here. They're dumping the high momentum, high growth, high multiple names once again, and they're migrating to the defensives, the dividend-paying names, the inflationary kind of names. We're talking about industrials, energy, defensives, REITs, utilities, materials. All of these sectors are the top performing sectors for December. When we look at the weekly performance, it was an easy week for the market. The seasonality is in play. Pretty much everything lighting up green, led by the big caps of Metaverse, and Tesla, the biggest gainers in the big caps here. Yet we also saw rebounds in the oversold names, the ARK Invest kind of names, the Chinese kind of names. All in all, it was an easy week for the market. Let's contrast this with the monthly performance of the heat map, and now we're seeing something different. Again, they're dumping the winners, the high multiple, high growth kind of names in biotech, in software, even the recent winners, NVIDIA, Adobe, AMD, Salesforce, Tesla, the Chinese names, more pain here, and they're sticking to the inflationary/value kind of stocks. We're talking about industrials, energy, the big pharma names, even within tech. The value names, the old school names, Cisco, IBM, AMAT, all outperform the market here. Likewise, the inflationary trade of metals, materials, agricultural kind of stocks, the fertilizer stocks, all outperforming, and the defensives, most importantly, consumer defensives, the staples, REITs, utilities, are leading the gains here. Now, let's contrast all of this with the year-to-date picture for the heat map. And again, we closed the year. The December performance was exactly the same theme as the yearly theme. This is the year-to-date theme. And look at this. The high momentum names got shot. The Chinese names got shot. The stay-at-home names, the winners of 2020, got shot. We're talking about Zoom, we're talking about Twilio, Peloton. They got hit hard. PayPal. But the majority of the market had a blast this year. Even in technology, chips, the big caps, the large software names with actual earnings and growth, banks, healthcare, the cyclicals, the reopening names also performed. The inflationary stocks of industrials, energy, materials also outperformed. Even the defensives, by the way. It was a good year for the defensives, whether we're talking about consumer staples, whether we're talking about REITs, and even some utilities. You're not going to see this kind of performance in 2020. We're going to have to be pickier than 2021. We have to pick the individual names here. And of course, we'll talk about all of that, the portfolio for 2022 on Sunday's video. Moving on to charts, let's start with the 30 minutes chart for the SPY. What's going on here? The chart has a bearish formation, the bear flag, whatever you want to call it. But all in all, the chart is working the overbought conditions that we talked about in the 30, the hourly, and longer dated charts via consolidation, which is a bullish pattern. The problem is you got to take it with a grain of salt, and the reason is the seasonality and the low volume this week. So we have to look down for support at 470 if this bearish formation plays out. When we get to 470, pretty much all the overbought conditions of the charts will be worked out at that point, and then we'll take it from there. What about the daily chart for the continuous contract for the SPY? Obviously, the chart is bullish. It is trading above the bull to bear advantage line, which is 4,657, and it is forming what it appears to be a bull flag formation, consolidation, gathering energy for another pop higher in 2022. The problem is, like I said before, you cannot take anything that happened this week seriously. You have to take it with a grain of salt because the seasonality was in play, and who knows what's going to happen when the volume comes back to the market. The assumption is when the volume comes back, it will come in the form of profit taking because the majority of the gains were already front loaded. The Santa rally, the seasonality, the stupidity is already factored in. And here's a 30 minutes chart for the Qs. What's going on here? We had what it appeared to be a double top formation from a 30 minutes perspective. And I told you that the center of gravity is 397. And it appears that we're getting closer to that number. The chart today formed a bear flag formation and it played out during the last 30 minutes of the day. What does that mean? This is a bearish closing, of course. Lots of profit taking from the so-called Santa rally, which means we're pretty much done with the so-called Santa rally. Let's see how the chart is going to perform at around 397 and then take it from there. But again, the underperformance of the Nasdaq versus the SPY, the Dow Jones, the IWM this week is a little concerning and worrisome, specifically when you dig down to individual names like Apple, the leader of the Nasdaq, failing for the third time to reach the 3 trillion threshold. And here's the daily chart for the continuous contract for the Nasdaq. What's going on here? It is playing out as we anticipated, by the way. We're revisiting the sloping line, which was resistance, now support, assumingly, of course. If the retest fails, then the bears will come out of the woodwork. But for now, we have yet to see the retest of that particular line. The momentum indicators have strengthened, but in the last couple of days, they started to stall here, and this is worrisome for the Nasdaq. Look at the volume. It came back on the downside. This is yet another bad sign for the Nasdaq. How about a 30 minutes chart for the IWM, the Russell 2000? What's going on here? We're shifting from bull flag to bear flag to bull flag to bear flag, and now we have another bear flag. And we have failed 223 by the end of the day. Is this bullish or bearish? The answer is it is bearish. So we have to look down for 218 for support. Now the bulls would argue you cannot take the action that we got today from the IWM seriously. You have to take it with a grain of salt because of the low volume. It doesn't work that way, sweetie, because the seasonality was on your side. You should have been able to pop higher here. What about the Dixie, the dollar index? What's going on? We've now lost the support of 95 for good. The weekly closing below 95. What does that mean? By the way, pay attention here. We have a negative divergence from both the RSI and the MACD indicator for the Dixie, which means that the old man is shining again. The mature guy in the room, gold is surging higher, and yet confirming the idea that perhaps gold will be a top performing commodity in 2022. The rising giant, the rising sleeping giant. We have a Fibonacci resistance here around the three amigos, as you see from the highlights, which is around 1,835. We'll see how gold performs at that point and take it from there. And here's a chart for the 10-year Treasury yield. What's going on here? The momentum indicators are getting stronger. We faced the resistance of 1.55%, went down and caught support from the very important number, 1.5%, reaffirming that number as support on weekly basis. Is this bullish or bearish? The answer is it is bullish. But here's a weekly chart for the TLT. What's going on here? Not a bad closing for the week, almost at 149, which keeps the debate and the argument, the mystery on the table, that perhaps the TLT will pop higher next year as bond investors assume that by raising rates, the Fed will dip the economy into a recession and therefore flattening the yield curve. Yes, the Fed might raise interest rates and the 2-year yield will respond higher, not the 10. This is the argument, of course, of the TLT fans who've been saying that deflation is coming and inflation is not going to happen, yada, yada, yada. They could be right at some point, so we have to keep an open mind here. And here's a 4 hours chart for the VIX. What's going on here? The MACD indicator was spot on this year. Every single time on the 4 hours, when we see green columns on the MACD, that produces a minimum of double-digit gains on the VIX. We're starting to see this happen in a week with favorable seasonality for the bulls. It is what we're seeing right now in the VIX, a formation of a bull flag that will pop higher, recaptures 20 as support, and perhaps rivals the prior high at around 36. And if that happens, it will come with a major down day or perhaps weeks for the SPY. Next, we have Apple, a daily chart. What's going on here? From a daily chart perspective, the formation is bullish. It is a bull flag consolidation, facing the resistance of the sloping line that we talked about before, in yellow, as you can see. And it's just a matter of time before it pops higher again, reaching the 3 trillion valuation at around 182.5. The problem is, and this is the bear perspective, why did the chart fail to pop higher and capture the 3 trillion headline when the seasonality was favorable to do so? And you come up with a conclusion that once the volume comes back, we're going to see a failure here and perhaps a revisit to 172.5. This is the bear argument. The bulls say, you know what, doesn't matter. This is a bull flag formation. We're going to pop higher and get the 3 trillion sooner or later. What about a 30 minutes chart for Tesla? What's going on here? You see it gapping down in the morning, the recall news. Hundreds of thousands of soufflés are being recalled for safety issues, of course. But yet again, the number is important, 1,090.5, acting as resistance once again. This was a favorable week for Tesla to pop higher. Why didn't it? Now, the bulls would argue, look at the chart, the overall picture since December 21st. What we see is a massive bull flag. Oh, we're going to pop higher again. The bears would argue, you should have popped higher during an easy week, and therefore, 1,090.5 already reaffirmed itself as resistance. What does that mean? It means Tesla has to go down and check support at 995 and then would take it from there. Moving on to tulips, what's going on here? A bad formation, folks. It was bullish. You had the saucer bottom, the bull flag consolidation, and it failed. When you fail a bull formation, here comes the bearish formation. Is what we're doing right now a consolidation of a bear flag? And if that is the case, we're going down to retest 42,000 once again. Look at the MACD and the RSI, the momentum indicators. They're getting weaker, and we're seeing higher volume on down days. This is not a good sign. BTC, at least for now. And lastly, what about AMC, an hourly chart? What's going on here? A down day, still trading within range, 26 as support, 32 as resistance. But are we trading closer to 32 or closer to 26? The answer is closer to 26. We're only above by about $1. So the apes have to do something here, because if we start to see some risk-off mode starting in the year, AMC will lose 26 as support. If that happens, it is game over, folks. You gotta defend 26 as support. So here we are, folks. Happy New Year. Before we celebrate, we have to go back and reflect on the year that was. And what a year, 2021. One for the books, where we saw the mania reaching extreme levels If you thought 2020 was crazy, think again. 2021 puts 2020 to shame. From the meme stock mania of GameStop and AMC, to the IPO mania, to the SPAC mania, to the Archegos disaster, to the deli shop in New Jersey that reached hundreds of millions of dollars worth of valuations, to Doge, to Shiba, to Rocket, to Rivian, to the NFT mania of spending millions of dollars on shit that doesn't even exist, to farting in a jar and selling those farts as an NFT for thousands of dollars. The mania has reached extreme levels. And I go back in history, we've seen manias before. We've seen human indulgence on mass scale, stripped away from rationale. We've seen that before. I've been in the bubbles of 2007, the real estate bubble, the dot-com bubble, but even those bubbles were limited to real estate and the dot-com, NASDAQ kind of mania. We've never seen such a mania on mass scale like this. The everything bubble. We've never seen anything like this before since the 1920s. We all know how that ended in 1929 and the Great Depression that followed thereafter. This mania sparked my interest to go back to the 1920s and study that era because I haven't lived through it. Even though I believe that I lived through it as a cat, yet my memory is a little hazy. One thing I realized by studying the 1920s and the crash that happened thereafter is the fact that almost a century has passed, and yes, we have advanced in technology, in knowledge, in science, in our values, but one thing never changed, and this is human psychology. The indulgence, greed, the desire to get rich quick, the herd mentality, the FOMO, all of these things, the psychological elements of the bubble in the 1920s never changed, and now we're seeing it on a mass scale once again. Another highlight of the year is the crime of the century that continues to go on, the largest transfer of wealth in human history, from the poor, the middle class, and the future generation to a handful of rich individuals today. And this was enabled, of course, by the Federal Reserve's misguided policies, perhaps intentionally. The Fed seized the opportunity of a pandemic to unleash the tsunami of liquidity, trillions and trillions of dollars, all under the excuse of an emergency accommodation to help the economy and prevent job losses. And we all know that this was not the intention behind unleashing the tsunami of liquidity to prop up the stock market higher. The real intention was to make the rich richer by propping their assets' values higher, and the pandemic was just an excuse to unleash this massive transfer of wealth that we have never seen in human history before. In doing so, the Fed also gave birth to inflation that continues to hurt the poor and the middle class, with increased living costs, lowering the standard of living and the purchasing power of consumers as prices continue to spiral upward with no stop in sight. Inflation has been good for the Federal Reserve sponsors, the rich, the elite, but it has been absolutely crushing for most of us. Not to mention that Fed officials, Fed Reserve's presidents got caught insider trading using the advanced knowledge that they have and the control that they enjoy over financial markets for personal gains. And when they got caught, what happened? They just resigned. No punishment, no media coverage whatsoever. Matter of fact, I bet that 99% of the American public doesn't even know that Fed officials got caught insider trading and they got away punishment-free because your beloved media would never report on that. And of course, this was enabled by the failure and the incompetency, not just by our central bank officials, but also our health officials who promised us that by locking down the economy and destroying small businesses, we will flatten the curve. And we now know that the only thing that we have flattened is the livelihood of the poor, the middle class, and small businesses across the country. Meanwhile, cases are reaching all-time highs. My fear from all of this bubble is the following: that after the greatest wealth transfer in human history is done, as the bubble comes down crashing, that we will see a backlash, a big populist backlash, when people realize that they got fooled and played by their endeared leaders. My fear is that we will dip back into a recession, perhaps a depression that punishes once again the poor and the middle class the most. My fear is the destruction of the new generation of Americans who will live with less opportunities and an ever-shrinking American dream. This year, we've also seen the failure of the so-called capitalist system, which ceased to be capitalism, by the way, and it's more like crony capitalism, a gangster system that rewards the rich and punishes the poor and the middle class. After trillions and trillions of dollars have been already spent to prop up the equities and real estate market, hoping that some of these trillions will trickle down and create a prosperous economy, what we've been seeing so far is a fragile economy. Yes, recovering from a massive shock from the pandemic, but these gains are not sustainable. The next shock will bring us down again. Meanwhile, the only segment of the population and the economy that gets to keep and preserve those gains are the rich and the 1% who dump at the top of the equities market before the crash, and they get to accumulate and concentrate more wealth as they scoop these assets at a cheaper price once again. Another sign of this failed system is the contrast of the two emergencies. They tell us that we have an emergency that requires an intervention by the Federal Reserve to prop up the equities market to keep this economy afloat. And notice how that the emergency never ended on Wall Street since 2009. On the other hand, have you noticed that the emergency for the rest of us has already ended? For example, governments initiated evictions moratoriums to prevent residents and renters from being evicted amidst the so-called emergency. But now, even as cases reach all-time highs in the health crisis, have you noticed that these so-called emergency protection measures for average folks have already expired? Another sign of this failed system is the rise of labor. This year we have seen many labor strikes revolting against the system when their employers are rolling in billions and billions of dollars of profit and revenues benefiting from this inflation, yet their workers have actually gotten a pay cut when you adjust to inflation. And therefore, we have seen the rise of labor and labor strikes across many companies. And this is just the beginning before the inevitable happens and robots take our jobs. What would the popular backlash be at that point? But folks, we have to end on a positive note here. Perhaps a sign of hope. Look at this channel, for example. We started the year with less than 1,000 subscribers, and now the channel has over 30,000 subscribers. Still a small channel, but with the little mic, the little voice that we have, we are speaking up, and other people are taking notice. The viewership for this channel has grown worldwide, whether we're talking about the US, every single state in the US, Canada, Mexico, South America, UK, Germany, Poland, Australia, New Zealand, South Africa, India, Korea, all over the world, people are starting to listen. Likewise, the average age for this channel went down, and now the majority of viewers are in their 20s and early 30s. This channel is also getting more diversified as more female viewers join us. And if you want a sure bet in life, start buying call options on the female viewership of this channel, because the moment I start broadcasting the show in person, the female viewership will skyrocket. The point being here is, when I started this channel, the goal was to document some notes for myself. I was just whispering some notes, jotting notes for myself. But I thought, what is the harm in making these videos public? What do you know, little by little, the viewership, the growth never stopped. And the channel evolved and grew to include many economic and financial market subjects. And folks, this is just the beginning, by the way. We are just getting started here. In the next year, we will go full on, full force, working hard to expand the outreach and the message. But for now, I am your host, the Maverick of Wall Street, and this is the last broadcast for 2021 and the last time I'm signing off for this year. I am looking forward for 2022, and I cannot thank every single one of you enough for your viewership and engagement with this channel. Thank you and Happy New Year.